listen-only mode.
Good day, everybody, and welcome to this presentation, Webinar of the Masters, with our special guest, Joe Ross. My name is Pete Kilman, and we also have Danielle Burbo here to help us out today with some questions and things like that. And I work for Trade Navigator, and let me just say, I want to thank you all for taking the time to come and join us for the webinar. I know time's important, and it's always a treat to have Joe Ross with us. The amount of knowledge and his willingness to share that knowledge makes it a fantastic journey for me every time. We've spent a lot of time together, many cities, several countries. I always enjoy the time that I get with Joe, always learning, always having fun, not just about trading, life, family, religion. When we were just talking with him about Uruguay, where he currently resides, and it was kind of a cool conversation, learn a little bit about that country. Always, like I said, it's always a learning experience, and it's really cool for me. So Joe is real fun and a very wise person. It's obvious to me he's figured out some things over the past 75 years. I mean, Joe's been around a little bit, and I believe with an open mind we can learn a lot from him. I consider Joe a true friend, a mentor for me in my life and even trading. And Joe made, going back to kind of a history, he's made his first trade when he was only 14 years old. It's a long time ago. Started really trading at the age of 22 with his uncle. That's still 57 years of experience that he's, calculating from 22 years old. So well-known master trader and investor, survived all these years as a trader with so many changes and crashes, wars, bad politicians, electronic trading. Doesn't take long to actually have to survive through the bad politician side of things, I guess, but shows that Joe has adaptability and style. He's a discoverer of the law of charts, using low-risk approaches that produces consistency in the market year after year. So consistency, a big reason he survived for so long, in my opinion. Joe has a bachelor's degree in science, business administration from the University of California in Los Angeles. Did his master's work in computer sciences. He's listed in many different things. Pretty well-known guy, written 12 major books and countless articles, essays. So lucky for us, Joe has been with us for all these years and has started sharing since the late 80s. So that's cool. And he just has a great philosophy in teaching that he should just simply teach the truth and tell people the truth about trading. So with that, I want to say, Joe, thank you very much for taking the time to do this webinar for our Trade Navigator community.
Yeah, thank you, Pete. I'm honored to be here, and I'm going to teach you how to earn while you learn today. I want you to know that obviously I can't go into every single detail of the strategy that I'm talking about and that we'll be talking about. It would take a few days to present the whole thing, but I can present you with the basics, and it's an idea, and then you can take it from there. Okay. Is there a way to trade so that you rarely, if ever, have to experience a loss? This is a serious thing that, all my life, in April 7th, I'll be 80 years old, and I've been trading now. I'm in my 58th year of trading. And in the last 8 years of that time, I began to discover a way to trade and not have to take a loss. It's kind of amazing, it's true, and I'm going to show you what it is. Okay, so we say, yes, there is a way to trade without losses. And it's not a get-rich-quick way. It takes some work, takes a little bit of study and understanding of this particular strategy. Okay, it's steady and consistent, a way to do it. It surprises most people when they realize that they could have been making real profits instead of regularly fighting losses. Okay, the way to profits is what I'm talking about. Now, how do you make profits and avoid losses? Not have them. I haven't had to take a loss in the last 2 years, not even one. Okay. Many years ago, the government of the United States created a way to protect investors from taking huge losses in a falling stock market. I believe it was around 1946 that this came into being. They allowed a way to create price protection, which is a form of insurance. In other words, they created a vehicle in which you could protect yourself against falling stock prices. Now, this is true also of futures, but this particular strategy will not work in Forex or in futures. You have to do it in stocks. Price protection is not something that the majority of investors ever use. Even though the government created it, most people are never told about it. Their brokers don't tell them that they can do this. And so when a market crashes, they ride all the way down to the bottom with it and just sit there absolutely frozen, not knowing what to do. Most lose their money without it ever having been explained to them that there's such a thing as a way to protect against falling prices. Okay, price protection, although relatively few investors ever used the protection that was made available by the government, there is a huge class of people who try to use this protection to speculate. Not the way the government intended it to be. These people are speculating using this vehicle that was created. Okay, and as speculators, they tend to lose. Okay, so let's look at investors versus speculators. An investor purchases price protection to protect against losses in a falling market. So it's something he can buy. He can buy into this vehicle to protect against losing money. This is how an investor works, although very few investors actually do this because they don't know how to do it. And even in many cases, maybe most cases, they don't know about it. A speculator purchases price protection in the hope of gaining a profit in a falling market. Okay, so he's not doing it to protect himself. He's doing it to make a profit. He's speculating, hoping to make a profit. Speculators far outnumber investors when it comes to price protection. And the speculator's motivation for profit, rather than capital preservation, is quite different from that of an investor. He's got a completely different mindset, a different purpose. He's usually trying to get rich quick. There's a third party involved with the ability to protect prices, and that party is known as the trader. Okay, so you have the investor, you have the speculator, and now you have a trader. And the trader is the person who provides the insurance. Traders make money by selling protection to investors and by providing a market in which speculators can try to make profits. Traders sell to both investors and speculators. Okay, and this is the strategy that involves being the trader, selling to both the investors and the speculators. Traders with the right knowledge can provide both protection for investors and a venue for speculators. while rarely, if ever, having to experience a loss. Yeah, repeat that. Rarely, if ever, having to experience a loss. Okay, now this is something that's worthwhile, not to have to worry about losses. Does that sound like a business you'd like to be in? Well, after 58 years of being a speculator, I've become a provider, a trader of price protection or price insurance. Okay, and I actually started 8 years ago, and it evolved. I didn't start out doing it the right way, but eventually I honed it and played with it, and until finally got it to be right, and still doing things to make it even better. With patience, it provides a way to almost always win. I say almost always. The chances of having a loss are something less than 1%. You might ask, why would a trader of so many years switch to selling price insurance? And the answer is that after years of learning to love losses, I switched to not having to take a loss. Not even once in the past 2 years. And from that point on, I don't ever expect to take a loss. Ever. And let's look at an example. On Thursday, the 5th of February, Texas Instruments was swinging sideways in a trading range. Going sideways, not really trending, it's just swinging, right? It swings up, swings down, up, down, right? Trading range, not really going anywhere. On Friday, the 6th of February, prices dropped sharply. That's this right over here. Reversing direction. Okay, so we have a reversal bar right here. Speculators saw a chance to make profits if prices would continue to fall. So the speculator is looking at that and saying, wow, it just reversed up here near the top of the trading range. It's probably going to come all the way down here and I'll make money. That's the speculator. Fearful investors began to worry about falling prices. Traders sold them price protection. Okay, and traders sold these speculators price protection. Speculators, sensing a chance to place a bet on falling prices, purchased the price protection provided by the traders. Okay, so the traders were selling to two kinds of people in the market. Prices fell again. Investors were glad they had purchased the price protection. Speculators were grinning about the smart move they had made by placing a bet on falling prices. The next day, prices turned and rocketed higher. Investors breathed a sigh of relief. Speculators began to be anxious. Gosh, maybe they made the wrong move. Traders are already happily seeing profits. Prices moved higher again, taking out the old high that was way over here, right? They took out that high. Investors were happy. They didn't mind, they bought insurance, but they're happy that they didn't need it. But speculators were grinding their teeth. Traders were winning even more money. Prices gapped higher. Now investors were ecstatic. Speculators were in despair. Traders were joyous. They had bagged the win in only 6 days. So from the time they sold this insurance, which is back here, they already had their money. They didn't have to worry about it anymore. Some investors and speculators sold their position for salvage value. whatever someone would pay them. Investors went to the bank to deposit the money they had received for protecting prices. Okay, one of the best businesses in the world, if not the best business in the whole world, is the insurance business. And that's because the insurance company or the insurer gets his money up front and may never ever have to pay a claim. How many years have you had car insurance and maybe never had to make a claim? But all the money that you paid was kept by the insurance company. And that's why we're being the insurance company here, which means we're underwriting risk, which means we have to be careful about underwriting risk. Let's look at some numbers. Okay, the opening date of the trade was 6th of February. Closing date of the trade was the 12th of February. And in its 6 days, the symbol for Texas Instrument, TXN, the price received by the trader was $60. Okay, that's if he did one insurance contract. If he did 10, he made $600. The stock price that was being protected was $52.50. Okay, so this is if it would go below that, then the insurance might have to pay off. Maybe. I'll show you later that you never have to pay it. The final date for the protection would have been March 13th of this year. Okay, and at that point, the protection expires. It's not needed anymore, and it ends. The number of days paid for price protection was 35 days. Okay, so somebody paid for price protection for 35 days against prices falling below 52.50. But we were only in this, only had to insure this price for 6 days. So what was paid for 35 days was earned in 6 days and no more risk. The payout to the trader for providing protection was 1.14%. Trader's good faith deposit that had to be put up by the trader was $1,050. Trader's annualized return on the investment was 59.6%. Nice. You know, what are the banks paying? 2% or a negative if you go in Europe. Trader's actual day of protecting before protection was canceled was 6 days. The seller's profit in 6 days, $30. Okay, this was what was kept. Annualized yield based on days actually protected, the 6 days, was 173.8%. Okay, you're going to have a copy of this. You need to read this and let it sink in. This is pretty good money. Of course, you can't do it every 6 days. If you could, it would be phenomenal. But you can be how often you can do this is quite often. We're able to sell price insurance 4 out of 5 days in a week, and we leave 1 day open, so just to have 3-day weekend. You might be wondering, what was it that the government made available that could offer protection against falling prices? You know, what was this thing? Why don't people hear about it? And why do people who do hear about it all wrong and get scared and run away and don't use it? I'm sure by now some of you have figured out that it was a derivative. But before you panic and run away, at least give me a chance to explain about how I use the derivative known as an option that have had no losses in the last 2 years. In April of 2014, I began teaching others what I do. And we closed out our first trades in May of 2014. Okay, in May, we closed 13 trades, in June 10, and July 12, and you see August 15, and so on down the way. There was 90 trades between April and December 31st. Okay, the dollars of margin needed for these trades, for all 13 trades, was $9,000. This is what you would have in your account. $8,400, $10,800, $13,560. That was the most. So you can see even with a small account, you can do this strategy. Okay, so this was the highest amount, and I guess this was the lowest amount needed for these 11 trades. Okay, the average days in the trade for the whole year was 19. So 19 days we're getting our money, earning it completely, not having to do anything, just take the money to the bank. The dollar profit doing one contract were like these. This is what we're making. You know, in other words, like 15 trades, we made $408. This is trading one contract or one lot, or however you like to call it. The most we ever made was this, $455.50, and the least was, I think, $245. Okay, and on the year, made $2,701. You know, and if you did 10 at a time, you made $27,000 and so on. Some people do 20 and 30 at a time. The annualized yield percent were as follows, what you see here. I guess this was the highest annualized, and the lowest was over here, 34%. Compare that with what you can get at a bank or a bond or a mutual fund. Considerably more. Average over the years, 64.5%. Uncovered options have allowed me to trade without losses. That's right. Believe me when I tell you that it can be done. And during the entire time you can relax, knowing that you have found a great way to provide a real service along with the profits for yourself. Okay, so this is a win-win situation. You're providing something that people need, and you're making money at the same time. Uncovered options offer some unique benefits. Losses are rare, if ever. You're able to offer a service using other people's money. Wow, think about that, right? You know, not even using your money, using somebody else's money to do it. Just like an insurance company, right? They use your money to insure you. Pretty slick. You're able to earn while you learn. Okay, so if somebody learning to do this strategy is earning money while they're learning how it works. Income instantly flows into your account. Right, you get the money right now up front, just like an insurance company. They're not going to insure you till you cough up the money up front, and they then have your money to use. Let's be specific. I'm talking about selling uncovered put options to speculators who buy them and to investors who use them for protection. But isn't that dangerous to do? Yeah, a lot of people think it is, but it's not if you do it right. Okay, not if you know how. Okay, spent 8 years figuring out how. I've been known how for 2 years and been teaching it since now it's a whole year. In this webinar, I have time to give you only a few details. However, if you get nothing more from this webinar than the idea that you can trade without fear and without losses, I will have done my job. The feedback that we get from people who are on this program and who are learning this strategy is that they can sleep at night, that all fear is now gone from their trading. They now know precisely and exactly what to do in every single situation that comes up in the market. They know how to protect themselves. They know how to not have a loss. Okay, the rest, after I show you what I'm going to show you, you can develop on your own, as I did over a period of 8 years. Or you can take a shortcut and join us in a program called Instant Income. I wonder if you've ever thought about the fact that an option offers protection to an investor is actually price insurance. Yeah, you probably never thought of that, right? You think, oh, trading options, yeah, I tried that and I lost my butt. No, it's not that. If it's used the way that the government intended it to be used, it's insurance. Right? We're not option traders. We don't care about ratio backspreads, iron condors and butterflies, and dangles and wangles and strangles and whatever, straddles. We don't care about that. We're just selling insurance and making money. Just doing what the government said somebody ought to do. I wonder if you've ever thought about the fact that insurance is probably the best business in the world. And why is that? It's because insurance allows you to be paid up front, instantly. You have the use of somebody else's money. Insurance allows you to trade or invest with other people's money up front. Insurance enables you to provide a service for which you're paid. You want to be paid to trade. I assume you want to be paid to trade. I know I want to be paid to trade. With insurance, you're familiar with the risk before you even take it. Right? This is what's called underwriting. And we can underwrite risk. And we know exactly what our risk is before we take it. Options for price insurance. I know that people are turned off by options. A lot of people have had bad experiences with options. And I imagine as soon as I said the word option, a whole bunch of people turned off this podcast. I know that people are afraid of them. I know that many of you have tried them and lost. However, options are the way the government provided for price protection insurance. So when they're used correctly, it's very lucrative. It's a lucrative business. If used the way the government intended, you're able to win on average 80% of the time, according to a bunch of false statistics about options. But with the way I will show you, you will win far more often than 80%. In fact, it's very rare if you ever have to sustain a loss. Okay, you know, you may have heard that, and it seems to be industry knowledge, which is totally false, is that 75 to 80% of all options expire worthless. You may have heard that, but it's wrong because the study that was done on options that came up with that answer was looking only at the day when options expired. Most people got out of those options long before expiration. So it turns out that only 5.5% of options expire worthless. Interesting figure if you never heard it. But even that's wrong because you don't know how many of those people actually won and how many lost. It's not known. So, you know, how to lie with statistics, this is what you're getting when you read these things. But I can tell you that unless the company whose price you're insuring would actually go out of business, you would never, ever have a loss. And so you just have to make sure you're insuring prices on companies that are not going to go broke. The government did not provide options for speculation, which is the way most people are using them. Selling insurance is not investing, and it's not speculating. Insurance provides a service with a known risk to the insurer. If you take away the risk, it's really lucrative. What is the risk when selling price insurance through uncovered put options? The risk is that prices will move down slowly, or that prices will move down fast and crash. That's the risk. Since most of the time prices do not crash, we have time to cover only the situation where prices move slowly. But I can tell you, and I can't go into it here because it's fairly intricate, is that even a crash won't hurt you if you know how to handle it. There are ways to protect against falling prices, whether they fall suddenly or slowly. Just as with any insurance company, we have the ability to buy reinsurance. Okay, when an insurance company doesn't want to take a huge risk, they can go and buy reinsurance. Okay, when an insurance company feels it is taking too much risk, it can sell some of the risk to a reinsurance company like Swiss Re. I can remember being in Zurich, Switzerland, and trying to find Swiss Re, and it was raining, and I had no idea where it was, and trying to ask people who only spoke German where I could find it, and wandering around in the rain thinking I'm going to get pneumonia because it was already November and it was cold rain. Just like you can with an insurance company, we too can obtain reinsurance using the same vehicle provided by the government, an option. Okay, now one of the ways that we can protect ourselves, not the only way by any means, but one of the ways is called rolling out and down. What if a trade goes against us, right? We insured 52.50 on Texas Instrument. What if prices started going down and even went below 52.50? Would we lose? Well, we have a decision to make. And here's an example, right? This is Microsoft on March 13th. Oh, that's not on 19. I'm sorry, it's April 4th, 2014. That's how much data there is going all the way back to 1986. Okay, but we're in the trade or looking here at April 4th, 2014. Okay, and this red line is the strike price that we were protecting, $40. I said, if it goes below 40, we got to do something because we're insuring $40. I had sold price insurance against prices falling below 40. I originally insured the May 17th Microsoft $40 put for a premium of $1.25, a return at the time of 85% on margin. On April the 4th, Microsoft dropped below $40. Okay, now, did I panic? Did I wet my pants? Did I get all flustered? Run in circles, scream and shout when in danger or in doubt? No. I just decided to roll out and down. To accomplish that, I bought back the May 17th $40 put at a cost of $1.47. At that point, I was losing 22 cents per share, or $22 per insured option. An option insures 100 shares. And here you see the prices. I know over here to buy it back would cost $1.47. Looking at the option chain, I saw that I could sell a June $39 put for $1.28 if I rolled out to June and moved down one strike from 40 to 39. Or I could sell a July $39 put for $1.53. All right, so I could sell for $1.28 here, or I could go down here and maybe get $1.53 if I'm willing to wait until July. What I'm doing is selling more time. I could buy back the May 40 put for $1.47 and sell the June $39 put previously sold for $1.25. Right, and so I would have $1.25 minus $1.47, negative 22 cents, but put back $1.28, okay, and end up with $1.06 of other people's money. Not my money. It's their money. Or I could buy back the May $40 put for $1.47 the same way and sell the July $39 put previously sold for $1.25. I have to buy back for $1.47. I lose 22 cents, but I could gain $1.53. Okay, which would give me $1.31 of other people's money. It's $1.31 per share times 100. We can accept the lesser amount or go for the greater amount. Okay, so we have another decision to make. Which one do we want? Let's look at it from the point of view of return on margin. The June 39 put return on margin, okay, was $106 is what I would end up with, divided by the margin, divided by the number of days at risk, 76, times 365 days in a year times 100, would give me a return of 65.27% if I do the June. If I roll down and out to the June. Okay. Something doesn't look right here, but maybe I'm forgetting what I needed to do. Okay, the July one would be, I would get $131 in my account. Divided by 780, that's the margin requirement, divided by the number of days at risk, would be 103 days at risk, times this many days in a year, times 100, because, right, 100, is 100 shares in this option. Gives me 59.51%. Now, which am I better off with, this or this? I'm sorry, and this is return on margin. This is return on principal. Okay, in other words, if I put up 100%, not just margin, okay, the principal is $3,900. The $39 put times 100, 39 times 100 times 100, right? 3,900. Okay, so return on principal would have been that, and over here, if I did the July, the return on principal would be 11.90. So I get a better return if I do the June than if I go out July, because I have to give more days at risk. I think the June option is better. Holding an extra month doesn't offer much. In fact, it offers nothing as far as return goes. Let's look at it from the point of opportunity costs. Right? We want to be capital efficient in what we do. Now, good underwriting, it makes you be capital efficient. You know, what's the payout on this thing? June 39 put return on margin is 65.27%. The June 39 put return on principal is 13.05%. The July put return on margin is 69.51%. The July 39 put return on principal 13.90%. Okay. It's not, again, June is going to win because there's not enough extra. We would have to hold another 28 days to pick up an extra 4.24% on our money. And that doesn't make sense. One of our goals, and a very important one, is to sell insurance as often as we can. Okay, we call this rolling out and up. On February 13th, I insured AT&T, May 16, $30 put for a premium of 30 cents. A return at that time of 20.27% on margin. By April 4th, AT&T had risen to over $35. I decided to roll out and up. To accomplish that, I bought back the May $30 put for a price of 5 cents, pocketing a profit of 25 cents. I was able to sell a $34 put option for 34 cents. That was a return on margin of 44.51%, or a return on principal of 8.9%. Okay, so I was able to move up and yet get more money. And the original one, I'm keeping the money. I'm already done with that. If the $34 option were ever to get into trouble, I could simply roll out and down, covering my loss by selling a lower strike at a premium that would bring a profitable situation. Knowing when to roll out and down. How do you know when to do it? You roll an option out and down the moment you feel the option is threatened. Sometimes I roll an option when it gets as close as 2 strikes above where it's sold. Close is going to be a matter of how many strikes there are, how much premium you have to spend to buy the option back, and how much premium is available for you to receive, and how far out in time you have to go to still be profitable. Okay, and I know I'm going fast, and I know I'm talking about a lot of things that you may not know, you know, and so just a little basic option course like telling you what a put is and what a strike is and so forth. Strike basically is the price that's insured. Certainly you want to roll out and down if prices touch or go through the strike price. I try to never allow an option to get that close. But as we saw in the Microsoft example, it can happen. It went below the strike price, went below the price that was insured. How do you know when to roll out and up? Anytime you can buy an option back at a profit and see that you can comfortably move to a higher strike price in the same or an even less distant month, you should consider buying back and rolling up. Okay. There's an idea here that I want to get across to you, and that's this. A supermarket often makes 1/2 to 1% on their inventory. That's all they make. But if they can turn that inventory 30 times a year at 1%, they're going to make 30% on their money. Okay, so what a supermarket's interested in is moving product fast. So they'll give prominent space on the aisles and on the shelves to stuff that moves fast, so they can turn their money over and over and over, making that 1/2 to 1% many, many times a year. And we want to do the same thing. Every time we can buy it back and sell more, we do. Turning our inventory, turning over and over and over and over. Okay. Knowing when to roll out and up will happen most often when stock prices are rising. But be sure you don't get too close to the price action. The level of comfort you require is entirely up to you. We all have different comfort levels. We all have different risk tolerance. As you go forward, remember this secret. One of our goals is to sell price insurance as often as we can. Okay, when the market's rising, we can sell it really, really often. And when a market is falling fast, if we manage our money correctly, we can make outlandish premiums for selling price insurance. In 2008, I think it was, I was able to sell price insurance on Tiffany's, T-I-F-F, I think it is, TIF is the symbol. I was getting prices for price insurance that the price of Tiffany's would have had to go to negative 15 cents per share, which is impossible, in order to justify the prices that I was getting for my price insurance, because the market was crashing. So we always want to hold back some money in reserve to take advantage of that. And we protect ourselves with reinsurance. Okay, why do we want to turn it over as often as we can? Because we want to turn our margin money as many times as we can during the year. The more times we turn it, the more money we make. Right? If you get a 10% return 4 times a year, you're going to make 40%. If you can get that same 10% 8 times in a year, you make 80%, just by turning it more often. So instead of waiting for an option to expire, we buy it back as soon as we can buy it back for half of what we receive for it, thereby doubling our money. Are you aware that a supermarket can make money even if all they make is 1% profit on sales? Sorry, there's a missing F here. If a supermarket can turn their inventory 30 times in a year, they will make 30% profit on sales. We want to do the same thing with our insurance. Turn our inventory as often as we can. Hey, the average number of days, if you remember this slide, the average number of days in a trade was 19. That means if you divide 19 into 365, that's how many times we could have turned it on average. Since most trades we enter have 45 to 60 days before they expire, 19 days means we are turning inventory as much as 3 times faster than expected. It's the fast turnover that enables us to have such high return on margin. 64.5% on margin. If you can turn an average annualized 64.5% on margin, I think you would want to look twice at this way of trading. It's the way you view the strategy that counts. When we view the strategy for what it really is, for what the government intended, that we begin to understand that we can realize an exceedingly high percentage of wins. Put options were intended to be price insurance, and we can be the ones who provide this insurance to those who want it. So let's review the concept. When we sell price insurance, we are not option traders in the conventional sense. We are providing a service to those who want or need it. We are paid for providing this service. Therefore, we can earn while we learn. On average, we will profit at least 80% of the time, but as I'm telling you, it'll be more than that. With additional strategies, we will profit a much higher percentage of the time. And in the last 2 years, for me, it's been 100%. When we sell price insurance, just like any insurance company, we are paid up front and we have instant income. We receive premium, same as any insurance company. That premium is ours to keep. It can never be taken away from us. We get it, and that's what we get paid for our service. As long as we have a premium credit, we have the use of other people's money. Other people's money, and we are paid to trade. If a price move would turn our credit into a debit, we can roll out and down and then get back into a credit. When we sell price insurance, when prices turn back in our favor, we can roll out and up, thereby shortening the amount of time we'll be at risk. Because we carefully choose stocks according to the parameters set out, about the only loss we incur is loss of time, when we have to hold risk longer than expected. We're able to acquire reinsurance in case the risk becomes too great. We have available additional strategies for handling any imaginable situation, but we can't go into them here. I know that many, if not most of the people watching this presentation are futures traders. For 50 of my 58 years of trading, I too traded futures. However, the instant income strategy can only effectively be done using dividend-paying stocks. the fact that a stock doesn't expire like a futures contract does makes the strategy possible. When done correctly, the only way you can ever lose is if the company whose stock price you're insuring goes out of business. I've given you all I can, and I know you can do this. However, if you want to earn money while you learn the intricacies of the strategy, you can join our happy band of money-making insurers. They tell me that for the first time in their trading careers, they have no fear. They no longer have to sit in front of a screen all day. They sleep peacefully at night, knowing it's close to impossible to lose. To join our happy band of traders, there's a link here that you can follow. Just go right there, right to our home page, and you'll see everything you need to know about this. I wish you all the best as usual. I'm always wishing you the best. I want so bad for you to make it. You cannot imagine. After all these years, you know, teaching and training people and coaching, and my biggest reward is if you make it, right? When you write and tell me that you're now a professional trader, that you're earning your living this trading, that's the best thing you can do. Okay, that's it. That's all I have. I'm open for questions if people ask.
Yeah, Joe, we got some good ones. If you don't mind, I'll go ahead and read some of these questions out loud. So the
no, I don't mind.
I actually I had a comment too. When you were talking about options and derivatives, one of the theories I had, and you can tell me if I'm right, like when I trade options on stocks, and I've traded some futures options as well, it seems like on the derivative side or the stock side, there's a lot of different market makers and a lot of places you can trade that option, and therefore you have a lot more competition in trading stock options. But for futures options, it's all on that one exchange, and it doesn't seem like your bid-ask spread is very good, and that's where I think you might have a harder time selling insurance there. But that was just the theory I had. But we have some good comments too. We are recording this. That's a question we got already and answered. But we'll move on to questions for you, Joe. When you get a loss, when you did get a loss, what kind of percentage were we talking in regards to your margin?
Well, how can I answer that when I haven't had one?
Okay. All right. How about what would happen if, you know, can you get assigned the stock, underlying stock, if it does blow through your strike?
You could if you don't roll out. I mean, rolling out is the key to this whole thing. There are other advisories out there that teach you to sell put options and get instant income and you know, income this and that, trading for income. There's a whole bunch of them, and they all allow themselves to be put, and then they turn around and try to write a covered call. If they can, if they're too deeply put, and in other words, prices are so far away from the strike, then they just try to own the stock. Okay, that is the worst thing that can happen other than the company going out of business. I mean, it's conceivable that you can reach a point where you can't roll out and down. Okay, but what we have strategies for when that happens, that we can keep adding premium and adding premium and adding premium, and we push the risk far out in time. And so we can have like 2 years to wonder if this thing, you know, give it a chance to make money. And during that time, we can trade and make more and more premium while we're waiting during that 2 years. I mean, it's conceivable that that could happen. It's conceivable that you wouldn't know what else to do because most people don't know how to protect themselves, that you would be put and can't write a call. And this is why we use only dividend-paying stocks, because in that situation, at least you can sit there and collect dividends till the stock starts moving again.
Okay, that's
If
good.
you're collecting dividends, you're making money.
So, I mean, what you've done today, by the way, in my opinion, with the whole comparing it to insurance, because that's really what it is, made it a lot easier to understand, at least for me, because I actually did trade stock options and future options, and I've never been successful so far, and I haven't tried your method, but never have been successful myself. On those, I've been a successful futures, but I've never been able to do that. Some comments after that question. I've been on IIG since late January, 17 wins, 0 losses so far. Another comment, my dad realized insurance companies run the world. He told me that a very long time ago. And then the next one is a good question. Why not credit spreads? Much less margin equals better ROM and no open-ended risks. Why not credit spreads?
We're not option traders. That's an option strategy, right? We're not option traders. We're sellers of insurance.
But in a way,
that's my answer. We don't do credit spreads. We can, but we don't.
Okay. All right.
There's a situation where we do. You might call it a diagonal spread, but if you get a credit, but yeah, we're not option traders.
Okay, you're insurance guys. You're insurance writers. Okay. Do you sell weekly options instead of monthly options so that you're increasing the number of times you're selling insurance?
Yeah, definitely. Definitely, we use weekly options and the monthly options both.
Okay. Is there any benefit of one over the other?
Yes, there is. Obviously, the weekly ones give you more opportunities. And usually the strikes are closer together on weekly options than they are on monthly.
Okay. Here's another comment. I took the IIG class last year and can testify that this is absolutely the safest way to earn premium on your money. I would advise anyone watching to take the full course. That's a good comment. What happens when the market crashes? Good question.
Okay, yeah. Well, we're unable to go into it here, but there are strategies that we can use in two forms. One is using reinsurance along with rolling out, which makes a whole difference in the crash, and the other is through money management, right? Making sure you have enough capital to take advantage of the crash, because during a crash, the option prices go to the moon, and you want to get the benefit of that. So you want to sell insurance during a crash.
Okay, and what happens to the actual premium not premium, sorry, the margin on selling an option during a crash? Does the margin go up exponentially, or?
It could, depending on the broker, right? It's traditionally it's 20% margin. I know at the broker I'm using, I pay 15% margin. But it's always up to the broker what the margin that they want, and it's conceivable that the margin could become very high in a crash.
Okay. Is this part of your is this part of the Money Masters book?
Yes, the Money Masters book talks about this, but not in great detail. Money Masters book is showing you how to make money in a lot of different ways, including just buying a stock without using a broker, going straight to the company, buying a stock and collecting dividends. It's the most simple, uninvolved way you can do it, all the way to this strategy here, which is covered briefly in that book, in that ebook.
Okay. Guido says, hi, Joe.
Hi, Guido.
What's the best way to find your candidates? Is there a scan that you've developed inside of Trade Navigator?
Yes, absolutely, and you're the one that helped me.
Yeah, I know. I was letting you answer the guy's question. Sorry.
I'm able to do it with it's view. What is it? View something? You have a name. I can't remember names anymore. View the grid or something.
Yeah, on the symbol, on the view the symbol grid button, there's a button called view the symbol grid, and then you pull up your list of candidates in the scan. So, okay, good. I'm glad we developed that. And the next question is the same as that question. Have a special scan criteria, identify potential trades. Would you ever use a vertical put spread or a diagonal in case of low volatility cases? That's a question.
Yeah, I already mentioned that we do use diagonal spreads. That's one way to get price insurance. And, you know, if the market is getting toppy, you know, and you're afraid and you want to protect yourself, a diagonal spread is fine.
Okay, great. Do you ever try to get the mid prices when you execute at IB? In other words, do you understand that question, Joe?
Yeah,
Oh,
I do. We try to get the implied volatility price if we can.
Okay.
But, you know, this is something else that we teach is, you know, how to get the orders, you know, how to deal with this. Where do you start and where do you end up when you're offering a price for the insurance? This is part of our strategy. It's proprietary how we do it.
Okay, cool. Thank you very much for the webinar from Thomas. Thanks, Thomas. Why is the number of days in the trade steadily rising beginning in September?
That's a good question. I don't know if I know the answer. The longest we've ever been in a trade was 244 days. That's one time it happened once. And the shortest we've ever been is the same day. You got in and out the same day. And then the average is 19. But probably because of that 244-day one probably yanked up the average. If you took that out of there, like I was looking the last month, in the month of March, so far we've closed out about 13 trades, and the average is something like 7 days.
Okay, and are you always selling naked, or you buy a far out protection sometimes?
Say it again, because I heard a noise and I didn't hear the end of what you said.
Are you always selling naked, or do you buy far out protection?
No, we're selling naked.
Okay, and what has been the max number of times you have had to roll out on a single trade?
Very good. Yeah, it's 6. I know there was one that we had to do 6, but that was rolling out down and rolling back up and rolling down and rolling up. But it was a total of 6 rolls.
Okay, great. This is a very long comment, and I'm just reading everything I can. Hey, Joe, it would appear you are selling naked puts. Many years ago, I gave $50,000 to a guy. Within 4 months of giving money, he had $88,000. Then there was a big loss. I was told this is 1 in 100 years, and that so it was slim to none. Guess happened again 3 months later. Another 1 in 100 years happening. My extremely well-known professional option trader took my option selling account from 88,000 to 8,000 with the loss of 90%. They were convinced that these catastrophic stars would rarely happen. However, it can and does happen. So what are you saying can be true, but it's not always the case, no matter how much you try. So it's just a comment. All right. Do you ever use Greeks for your trading decisions?
No, we don't like. No, we like Greeks, but people, but not Greek letters.
You don't like Kappa Beta Pi?
And I mean, we don't really use the Greeks at all. It doesn't have any application for us.
Okay. Um, so for this entry criteria, you teach that in your course, I assume, because people are asking more specifics on that, and I'm trying to get through it. The number of trading days rise, and okay, that was already asked. Hi, Joe. Is the strategy explained also in the ebook, Money Making Options?
No, no,
Okay.
money-making options is basically for futures, and yeah, it's totally different. That book is about selling option boxes in sideways markets and doing premium accumulation in trending markets.
Okay. And do you have a book that covers the strategy completely or thoroughly?
No, you couldn't put this really into a book. This is why we have actual 2 months of coaching every day, right, where we walk you through. I mean, you're told every part of the trade what to do and why, and much explanation. Every day there's a podcast and a PDF, and this goes on for 2 months, and then if a person wants to continue, they can continue with this daily guidance.
Okay. Yeah, we're getting kind of late in the game, so I almost want to see if I can pick a couple more, but I don't know. And Joe, you've had a long day, so do you want me to just pick a few more questions and call it good, or?
I'll go as long as they ask questions. It's
Oh,
fine.
sounds good then. I'm
Let's
cool with that
go.
too. Let's do it. Let's play Marathon Man here, which you're very good at because I know you drove for hours today. Um, will you send a link out for the recording? Joe, can I send a link out for the recording of this webinar to all of our past clients and clients?
Yeah, that's what's going to happen.
Okay, sounds good. Just wanted to make sure. In your June or July discussion, about the two different options, using the days till expiration in your calculations, in neither case you would have held the option to expiration. So each will be rolled on the same date if you, in theory, bought each. So the days to expiration is irrelevant? No? Question mark?
Uh, I don't really understand the question.
Oh, let me read. Remember when you were talking about the June or July expirations, and you were deciding which one to choose to roll out into?
Mm-hmm.
When you were doing that, what he's saying is you were looking to figure out which one to do based on days to expiration as part of your calculation. But in reality, days to expiration on that, he's saying wouldn't matter, or is asking if it would matter, because you're going to roll.
It would matter because we don't ever know when we can get out.
In one case, you may not have to roll out, and you just happen to let it expire worthless. In the other case, you'd still be on it. Okay.
We've rolled options like 2 days before expiration. And other ones, we roll them 2 days after we got into them. So.
Well, and isn't it true, Joe, that as you get real close to expiration, the depreciation of the option value goes faster?
Absolutely, but also the danger of being put increases greatly, especially if the put's in the money.
Okay, I think that's a good answer. That discussion there. So, if for example you had a 100K account, would you divide your capital into X portions and trade weekly, daily, or go all in 100K per trade? Ooh.
No. The most I would use would be 50% of my account. That's the most. Very often, because I trade managed money and with the exact same strategy, and we keep 75 to 80% in reserve. And for people that have IRAs and 401ks, they're not even allowed to use margin, and so they're using 100% and still making money.
Okay. Yeah, I mean, I don't even risk. I mean, risking 100% of any one account is pretty tough. The problem is too is if you're rolling out and in and you risk 100% of your money right off the bat, how you even have any money left to roll out? I don't know.
Right. Okay.
Okay.
So, I mean, those figures where I show return on principal is for people that have to use 100% of their money. All right.
Right.
They don't get a return on margin. They get a return on principal.
Yeah. Okay. Good answers. Okay. What happened? Okay, so stocks have been in an uptrend for the last 2 years, which is when I think you said you hadn't lost any trades or something. But what happens if market trends down for 2 years in a row?
Oh, wonderful. I mean, then we get huge put premiums, right? Volatility goes way up in down markets, and the premiums double and triple for the same risk. So it's really easy in a down market to write short-term expirations with deep in or faraway strikes. You sell option prices that are way distant from the current market, but with a very short time till they expire. So you make your money very quickly and you make double, triple premiums.
Okay, cool. Cool. That's actually pretty interesting. Do you trade more opportunities when volatility is higher?
Yeah, I would say that that's true. Yeah, because you find more premium, and so I mean, like right now, volatility is really low. There's hardly any premium out there uh, because we're probably nearing a market top, and this is when people are so confident, they're not worried, they're not scared, and like the VIX index is way, way low. It's hard to find premium in those situations.
Okay,
And
makes
so
sense.
we definitely sell fewer options when volatility is low and more options when it's high.
Makes sense. Makes sense. Good questions here. Keep coming. Great webinar. Thank you very much. And thank you from another guy. And moving on to the next question. Do you trade the strategy on indices or ETFs at all, or is it all just stocks?
You know, it could be ETFs if they're paying a dividend. Indices, no, because there's no dividend. Dividend is an absolute must requirement. In the event of a total disaster, at least you could collect the dividend.
And is there a number of times that you would roll before you finally decided, you know what, it's just time to cut losses and take a loss? I know you said you had a
No,
maximum 6, so you just keep going as long as you can. Okay.
yeah, we can. We have some that are in 2017 is for expiration. But between now and then, you know, we're trading inside this where the market is now versus where the strike was.
Okay, understandable.
If we
Is
have to go to 2018 when it becomes available, right? That's okay because it's not our money. We're trading with other people's money.
Okay. And what's the minimum account size needed to get started?
I just took a swig of water. Uh,
It's
the
good for you.
minimum account. We say 2,500 bucks. Now, let me elaborate a little bit on that. Okay, for 2,500 bucks, you're not going to get very many trades, but you can get one here and there. But you can take every trade on a simulator and learn, right? The purpose of the instant income course is to teach people how to do this so that they can do it on their own. And so the course is really primarily for learning, not trading.
Okay. Do you ever sell strangles as a strategy and roll up, roll down, or is this only put based?
Yeah, we have some strangles. Occasionally we do a strangle, but I'd rather end up with a diagonal spread than a strangle in most cases.
I don't know the context of this question, Joe, but I'm going to read it and see if maybe you do. It says dividends on selling put options, question mark.
You don't get dividends on selling the put. You get dividends on the stock if you happen to own it. We try to never, ever own the stock. Therefore, we don't expect to get dividends, but there is, I mean, you can screw up and end up owning the stock. I mean, you could just make a mistake, an execution error that puts you in a situation where you're not, oh my God, I got put. Let's say you forget about one. What's going to happen? You forget that you even have this. And all of a sudden you're put and now you own the stock. You want to make sure you have a dividend paying stock.
Okay. And let's see. Send me the recording, please. Does this class have a specific start date, or can you just start at any time in the near future?
Any day, any time. You start any time you want.
Okay. How can we see the scan in Trade Navigator? How do we get that scan from you, Joe?
We can show it to anybody who wants it. I mean, it's a program thing. It's based on criteria, and I can show you what it is, and you can tell them how to do it because I don't know how.
Okay. Yeah, that's fine. You got a degree in computer science, which, by the way, I do not have.
Yeah, and I could program computers. I was a systems programmer way back when, but now I'm not even a good user.
Yeah, now I'm more of a business guy. I know it's easier to hire a programmer than to become one, I think. So, do I understand correctly, you don't use the Greeks, but you calculate the important numbers by yourself by using the strike price, option price, stock price, and timed expiration, question mark?
Right, yeah, we don't need the Greeks at all. Why complicate things? The difference between, well, let me put it this way. Option traders, when they get in trouble, write more options or buy more options. They'll take something that's simple and make it very complicated and turn it into a condor or a butterfly or a back spread or whatever, one of these crazy things, because they're terrified to go in the underlying. Okay. On the other hand, a stock trader is terrified of options. So they're mutually terrified of each other. This combines both. This takes, and this is exactly what I did with futures options, to put the best part together. Take the best of the underlying and the best of the options, put them together. And then you don't need all this Greek stuff, and you don't need a bunch of fancy-ass option strategies.
Okay. Let me ask this question and then kind of make it two parts. Are the trade decisions made with end-of-day data? And I guess that concerns two types of data, options and stock data. So are the trade decisions made with end-of-day data for the stock side? And then do you need intraday or just end-of-day data for the option side?
You can use strictly end-of-day data on all of it. The last 2 weeks, my computer was down, and I just did end-of-day.
So when you go to buy the option, though, you'd have to know what they're offering you the option or offering the option price at, though, to make that trade, right?
Yeah, I mean, you can. I mean, I use the broker's platform. I use Investors Europe, by the way, and they use the same platform as Interactive Brokers. It's exactly the same TWS platform. And once I know which one I want to do, I just put in the order, good till canceled, and just let it. I don't even have to be there. I wasn't there all day today, and I had a diagonal spread I put in at about 6 a.m. this morning, and I was gone all day. I haven't even looked at it. I don't even know if I was filled.
Okay. All right. Well, that's relaxed trading. So what is the cost of the course?
I think it's, yeah, see, you asking me, like I knew, right? 2,900, I think. And what it is a 1-hour seminar that explains the strategy. It's another short workshop, maybe a couple of hour workshop. And then we want you to read the FAQ, because there's a lot of stuff in there. And this is part of learning, right? Reading the frequently asked question type thing, or maybe that's the wrong word. There's another word for those kind of things. And then when you're ready, you start taking joining in and getting the PDF every day and listening to the podcast. And this is where you're really learning, is seeing it in action. I mean, we make these trades ourselves, every one of them.
Okay.
Right? And see how we handle them and what we do and where we got filled and how we got filled and when we get out and how to place the orders, and all this stuff is in there every day. It's not theory, it's all real.
Okay. If the market falls really fast and really hard, we risk running out of rolling possibilities and being put the all. That's what it says, and being put all the stocks. Couldn't this bankrupt our account?
Not if you do the reinsurance thing, right? Because at some point you're going to be short right along with the rest of the market. You're going to own a put, and that put's going to protect you.
Okay. How do you choose the strike price?
Well, it's a combination of, what kind of premium you can get, how far away the strike is, what you're willing to, what your risk tolerance is. It's stuff like that. I mean, it's more than one thing, how you choose the strike. We don't want to get too close to the market. We want to get as far away as possible and still get a decent premium. And that varies, depending on volatility in the market. High volatility, you can get a lot of premium with a strike that's far away. And with low volatility, you have to get very close to the market to get any kind of decent premium. If you're going to get that close, then you need to buy some reinsurance because you're very close. So you use some of what you get to pay for the insurance.
Cool. All right. Well, we've got 2 comments left, and that was a couple of guys that apparently know you saying your diagonal was not filled, Joe. So with that, I think you've gotten it. I think you've gotten it all answered. Obviously, if anybody has any more questions or anything like that, are they free to email from your website? What's the email address?
Yeah. support@tradingeducators.com.
Okay. And what we're going to do, I'm going to type that in, support@tradingeducators.com, and go ahead and thank everybody for coming out today and joining us for this webinar. Thanks, Joe, for doing it for us. I know you had a busy day, and you got my curiosity going, and I learned some things as well, so that's pretty cool. I will get everybody the recording, and thanks for all the kind comments. Thanks a lot, Joe. Appreciate it, man.
All right, great. Thank you. I enjoyed it, and say, everybody, hello to everybody, and happy trading, right? Make money.
All right, thanks, man.